Hello, I'm Ken Monahan, and welcome to today's Greenwich webinar, Options Growth, Volatility, and the Outlook Following the U.S. Elections. Today is a great day to have a webinar on this topic as market activity was quite exciting and volatility had a huge increase. I'd like first for my panelists to introduce themselves. Stino, would you like to go first?
Sure. Yeah, hello, I'm Stino Melito. I'm the co-chief operating officer of Dash Financial. I started my career as an options market maker on the floor of the CBOE in 2000 with a firm called Boda Capital Management, and I've been with Dash since 2010.
Excellent, thanks a lot. Danny, would you like to go next?
Sure, I'm Danny Kirsch. I'm at Cornerstone Macro, head of the options desk. I started at Bank of America in 2006 in London working on the equity derivative sales desk and have been here for the last 5 years.
Excellent. And Will?
Great. Thanks. Will Bartlett. I'm the CEO of Parallax Volatility Advisors. Parallax was founded in 1996. We run a relative value volatility trading strategy, primarily trading listed options on U.S. stocks and indexes.
Excellent. Thanks a lot. So to level set, I've put together just a few slides, and I'm going to breeze right through them to sort of familiarize the audience with the main thrust of what we're going to be talking about here. First thing is this 2020 has been an absolutely spectacular year for volatility. Not many people know this, but the all-time record VIX close was set in 2020, and 5 of the top 10 all-time high closing prints were set this year. The second, of course, is 2008 during the financial crisis. But once again, the peak was set this year. That volatility has remained elevated, as today shows. We have not returned to the levels of volatility prior to the COVID crisis, despite a rather extraordinary rally from the lows of March. Interestingly, options volumes have largely exploded during the course of the year, and what's more, single name volumes have continued to explode and to increase even after the COVID crisis acute phase has passed. These three things, of course, have led to a serious challenge for market liquidity, and bid-offer spreads have been quite wide since the year began, and they are starting to creep up again, as you can see from this chart. And now I'm going to ask my panelists to chime in, and I would like to start with Stino and ask him, what do you think about the spike in options volume this year? What do you think is driving that?
Sure. So yeah, a couple of things. I mean, I think first, a lot of people want to talk about the growth in options this year, but from my perspective, this isn't really a new story. Growth in 2020, we did over 5 billion contracts. We were up 20% from 2017. That was our busiest year industry-wide. 2019, we were down slightly, but it was just slightly, and it was our second busiest year, from a volume perspective in the industry. And now this year, yeah, we're up another 20%, but 2 of the last 3 years, option volume has grown over 20%. So yeah, there is a lot of growth in options this year, but it's not the first year that it's grown. I mean, the option volumes have been growing steadily, for the last 20 years, and they've grown substantially over the last 2 of the last 3 years. We've seen huge growth. So I think there are some new phenomena going on, but this isn't totally new. This isn't out of the blue. I mean, our volumes have been tremendous, for several years now in the industry. And in terms of what's just driving, I think all of this, growth that we have seen, I think there's several factors. I just think, number one, education and awareness of options, has been, sort of accelerated tremendously over the last 5 to 10 years, where, options are now being used by, buy-side firms, are being used by, obviously a lot of retail are using options. Spreads, have, come in. I know they're up a little bit this year, but they've come in over the last, several years. Fees have gone down. So, I mean, there's a lot of things behind the growth of options, and people have learned how to use these to, not only take positions, but enhance portfolios. And there's just a lot more people using them today, than there ever been. And we've seen growth, again, not just this year, but for years, we've seen some tremendous growth here in the option space.
That's interesting. And, but you don't think there's a particular anything special about 2020 in terms of options growth? I mean, it's true the product has utility, right? So it's been growing for a while. but it seems to me that the volumes, in 2020 are significantly higher than they were in prior years.
Well,
I agree with you. Like, it's a useful product and it's been growing for a while, but there seems to be kind of a step change going on at the moment.
Well, I mean, obviously volumes right now, I mean, with COVID going on, I mean, obviously we've got volatility for the first time. So we've had increasing volumes for several years without a real, volatility catalyst to really, force a lot of people to have opinions. I mean, we've generally lived for several years now, and what I would say is almost like, kind of an opinionless, almost predictable sort of financial regime. That's out the window this year. Everything's changed with COVID, and there certainly has been obviously a huge influx of retail trading. I mean, we've seen that business has more than doubled that dash this year. So there are things going on, but again, we did a little over 5 billion contracts in 18. I think we're on pace to do a little over 6 billion this year. And in 19, we were just a tick below 5 billion. So yeah, volumes are up 20%, but they've been growing for some time for sure.
Interesting. Well, what's your view of this, Dan? Do you agree that this is sort of just a continuation of the prior trend?
Yeah. So at Cornerstone, what we're doing a lot, we're speaking to institutional clients and helping them trade. This year, we've had much more teach-ins. Clients want to learn about options. And we're also finding that because the last few years you had a market that was just kind of grinding higher, how are you going to get those returns that the S&P is giving you without sort of using some leverage? And so there's been a lot more interest in the option market heading into this. And then you've got an onset of volatility. You've got, obviously this retail explosion. And then also a lot of these stocks have, like a stock like Amazon trades at over $3,000. A lot of people, especially on the retail side, aren't going to trade one share for $3,000. You can't make any money. They don't want to make $50 on a trade. I want to make $1,000. I want to make $10,000. So you're seeing that interest in the day trader who's looking at, well, how am I going to make a lot of money buying Amazon? Is it going to double this year? Maybe, but I could definitely make a lot of money if the stock goes up 2% this week. And one way to do that is, and we're seeing this every day, and I'm sure Will is on his desk, keep moving your trade shorter and shorter and shorter dated. And that's where the volumes have exploded. It's these weekly contracts where, I can make 10 times my money buying a 5 delta call, far out of the money call on Amazon or Apple or these, far out of the money options. So
that's
go
ahead.
And one other big change is that how are you going to hedge now with rates where they are? So people are again flowing to the option market for their hedging needs because rates have taking their step. Now we're near zero. What are you going to do? And we saw this in March. Market tanked and treasuries tanked. The only thing that worked is there was only one game in town. The S&P and VIX was working.
I mean, that's interesting. What's your view of this, Will?
So I think the retail phenomena you guys have touched on is a real thing, and it certainly shows up in that mix, that shift or huge growth in single stock volumes, whereas retail traders don't want to hedge their portfolio with the SPX. To Danny's point, they want to speculate. And in fact, I think probably the worst thing that happened to Tesla is that it split 5-for-1, and it became more attainable. But the flows have been really consistent, and something we haven't seen. I haven't seen anything like it since the late 90s in terms of the speculation. It's really apparent out there. I noticed one anecdotal trend, and that is that as September rolled on and kids started going back to school, it seemed like some of the retail volumes subsided slightly. So I do think it's very much a fact of people were at home, they got stimulus checks, they started trading options because they couldn't bet on sports, and now they can start betting on sports, and their kids are going back into school. So it seems like it's subsided a bit recently, but the last couple of days have been a little different.
Well, that's interesting. And so one of the things you're pointing out is that basically people are using these as a speculative device because you can make higher returns, right? Is that something you're seeing across the board, both for retail and institutions, that they're basically using options as a leverage device rather than as a tool with an asymmetric payout? It's basically a way to get better leverage in the equity markets.
Yes, I mean, absolutely. And it's certainly a big change of this year is how SKU's been priced in U.S. stocks, whereas typically out of the money puts in single stocks have a much higher volatility than at the money or out of the money calls. And now we're seeing a huge bid for upside calls. People want to buy a call on Apple or Microsoft or Tesla or whatever their favorite stock of the day is. And that's on the retail side. And then in August, we saw this massive set of order flows that is believed to be from SoftBank, where they were buying out of the money calls and call spreads in basically 8 of the top 10 NASDAQ 100 stocks. So that flow in and of itself was huge and definitely shifted the market and is a big change in how SKU's been priced.
That's interesting. Is that persistent, do you think, or do you think the SKUs will come back to more normal levels over time, or do you think that's a secular change?
I don't know. I mean, it's hard to tell. It's certainly been persistent. You know, as you mentioned earlier, we're sort of markets near highs, and vol has stayed as high as it is. Typically, when markets rally, volatility contracts, and we're just not seeing it right now. I do think there's an opportunity trading longer-term SKUs because I think it's very hard for it to persist over time. But certainly in the short-dated options, the way the market's been trading recently, it's been the spot goes up and volatility increases. Yeah, it's hard to guess how long that'll persist for, but it's made hedging a little challenging.
Yeah, and I'd also chime in. I think that what would need to happen for that to shift a little bit is people need to stop making money buying calls. To go a few months with it not working, you'll stop doing it. And I think that's like the big change. If you just look at, one thing we looked at is just the performance of buying the S&P this year versus the performance of the BXM. BXM is just a SIBO 1 month. You're long the market, you're short a 1 month at the money call in the S&P. That's all it is. That index is down around 8% this year. The S&P is up 2%. So so the selling the calls is what's you're giving away all this alpha. I think that's not going to last. So my guess is if we had this conversation this time next year, because so many people have left the overwriting business because it's been such a bad business, perhaps it starts working if no one's doing it, sort of thing.
Boy, that's interesting. That is interesting. But and this sort of takes us to the volatility aspect, right? Which again, like this has been kind of an unprecedented year for volatility. It didn't hang in the same way it did in 2008, but it's been pretty pronounced. But this trend that you're talking about, sort of a change in SKU and also a shift in the volume towards like the front end of the curve, does it actually get harder to take advantage of those changes in SKU because you can't trade stuff further out, right? Where the vol would really tell?
I mean, there's a lot more, I would say, randomness to the results when you're trading very short-dated SKU relationships, right? If you trade a 1-year SKU position and you have a lot of confidence in it, chances are you're probably going to make money as SKU normalizes over time. But if you get short upside SKU and the stock's up 15%, you're going to have a pretty big negative result on a 1-week trade. So I think that there's a lot more volatility of the returns, and so it is more challenging. So in that case, you're really incented to diversify positions across a lot of stocks.
This has to be much harder to risk manage as well, right? Because of what you're saying is if all the volumes are sort of moving to the front, right? If you're providing liquidity into that, like your own positions are sort of moving to the front. So they're behaving, less like options and more like, levered stocks. Is that a challenge for people who are providing liquidity?
Yes. I mean, I think as everything's gotten shorter dated, yes, it has been more challenging to risk manage the portfolios. As I said, there is a lot more volatility of the results. We've certainly noticed it in our daily or hourly P&L, as the case may be. It's often a function of just the markets being more volatile, but also a function of the instruments traded being much shorter dated.
So, Stino, do you notice that as well? Is that a feature of your liquidity provision?
Yeah. I mean, obviously, we're more just providing tools. Obviously, Dash as an agency-only firm, isn't really. I mean, we're not doing any sort of proprietary trading. I mean, we are providing tools, to our clients who are looking to trade, volatility, and that is a request that we've had. I mean, we have had several of our clients reach out to us, over the past year, looking to trade volatility more. And when we built some tools around that, I mean, one of the things especially a lot of the banks that we do business with, we're looking for is, the ability to trade, Vega, and they're saying things like, hey, if I want to buy, 10,000 Vega in, December, and I want to pick these 6 strikes, and I want to sell 10,000 in Jan, and over these 8 strikes, they want tools to do that. So, we've really focused on delivering those types of tools to our clients to allow them to express their volatility positions, at the basket level, and even on the single stock level as well. But really on the basket level, we've released some tools recently that allows, our clients to put on those positions and really deal with just a few clicks of a button.
Well, that's interesting. So what kinds of tools do your clients use to sort of monitor and keep track of the volatility as it changes?
Oh, from that perspective, I mean, there's a lot of proprietary. I mean, when they're looking at sort of monitoring, their volatility, there's a lot of proprietary systems, that firms like Parallax uses. A lot of things are sort of built in house. There's a lot of third-party systems in terms of, how they sort of monitor and track, their Greeks. That's not a business that we're in. We're just providing tools for the execution side of the business.
Gotcha. Okay, that's interesting.
So
Go ahead.
Sorry, and I think we're also seeing like the size of the actual trades that are going up, the actual units that are trading are incrementally smaller. So it's 3 lots, it's 4 lots, it's 5 lots, and we're certainly see that from our desk, where when we're helping clients execute trades, instead of potentially, especially the shorter dated stuff, the 1 week options, the earnings trades, perhaps you're getting your 5,000 options in over the day, you're doing it in odd lots, but getting filled, it eventually fills, but it's almost like a T-whopping a stock. But the options market a lot of times is actually acting like that and providing that liquidity, because someone like Will, who might also have an electronic trading market making firm set up, they can then get their hedge off incrementally throughout the day, and they're not getting steamrolled with buying 10,000 options over the day, where the client doesn't necessarily get the best price and the market maker is also unhappy. That's the worst outcome. We want both sides to be happy, where a market maker can make money, but also the client can do well. So we continue to go back to the pool.
Wow, that's wild. So is that the sort of standard? Is it, basically people have to piece in large orders over time? And how do you decide between, if you're trying to get done in size, how do you decide between like calling up a dealer and like getting put up, or sort of piecing it in on the exchange in the way you're describing, right? Because I imagine on the other side of your order working it in, the people providing liquidity to you are probably trying to figure out like, well, how much is behind this? Right. I mean, that sounds kind of complicated.
Yeah, well, oftentimes you have a relationship with the liquidity provider where you're pretty open about what you're trying to do. Whereas I might have a directional view, a liquidity provider like Will, he might have a volatility view where I need to buy calls because I think the stock's going to rally 10%. He could then sell me the calls, go out and buy stock, and we can both win if we get a 12% rally. So that's kind of working with your liquidity provider. Now, at Cornerstone, we execute on an agency basis as well. So we certainly have clients who will go to dealers to find liquidity. They'll go to the OTC markets. But as we saw, even with the SoftBank, liquidity providers like Will and the ilk like that, we're able to step in and provide enough liquidity for this person to get done on listed options across the street where everyone can kind of see it and not completely outsize the market. I'd say it outsides the market marginally, but we're still here and everything's still trading. So to me, it sort of speaks to like, while volumes have exploded, while I think there have been, certainly some blowups in March, generally, and we were talking about this before, before everyone joined, it's been a pretty good year for option market makers. It's been a pretty good year for option users. And I think liquidity has been surprisingly strong if you're willing to use all the tools out there. If you're not just, I need to get done now that price might be a little bit worse and you might have to pay up to get, filled.
Yeah, that's good. Let's talk more about liquidity now. It's sort of the options volume story and the volatility story. These are well known. Let's talk a little bit more about liquidity. And I'd like to sort of follow on, Will, a little bit. Can you talk more to this this sort of trade-off between working things in and getting done, all at once, right? Are you noticing a change in that as normally, right? One guy can have a delta view, you can have a vega view, but if everything is shifting into the front of the curve, right, then it's much more a zero-sum game than options have historically been.
Yes, I mean, the biggest challenge is always the delta hedge, meaning that somebody wants to buy 5,000 up, whatever, 5% calls in a stock that's going to have earnings or some very short, doesn't matter what the trade is. We look at the delta impact of the stock because we're going to sell those calls because we think the volatility is high, but we also have to account for the fact that we need to buy the underlying stock against it to hedge our exposure. One very easy thing that people can do is to trade things neutral. Because your price, if you trade it versus stock and an option, the market you're going to get is going to be much tighter than if we're taking the delta risk, meaning that we don't have a view on stocks, and we're going to have to try and estimate how much market impact we're going to have to get in a hedge. So the bigger the order, the bigger the stock trade we're going to have to make, and obviously the larger the hedge and the greater the market impact we're going to have to do. Oftentimes you'll see orders where there might only be a couple 100,000 shares on the tape, and we're trying to figure out where we could go buy 50 or 100,000 shares of the underlying stock. And in this market, the stocks have been really illiquid too. And estimate of that price might be $1 or $2 higher in some extreme cases. And so people, when they look at the prices we'll show on those options, may think they're outrageous because they might be well outside of the posted market. But given the risk that liquidity providers are taking, it's accounted for, and oftentimes we under account for it. So we're often surprised by how much some of these orders can move the market.
Sure. It looked like the NASDAQ whale put up his trades or her trades delta neutral. Are you seeing an increase in delta neutral trades? Like, do the customers offer to trade delta neutral more often given the illiquidity in the underlyings? Or is it?
We certainly encourage people to do. We say, hey, we'd be here, but if they want to trade it versus stock, we could show you this price and let them trade the stock. They're the ones that have done all the work and are experts in this underlying stock. Oftentimes, it's the first time we've looked at the stock, or at least first time that we've looked at the stock recently when we were looking at these trades.
And I'd say one other big shift is also clients will look at spreads more often too. And I'm sure, this will help, like looking at a calendar spread in lieu of an outright option where you can kind of get the delta to neutral. So one other, this year there's been some large events. There's an election coming up next week. There obviously, there's Fed meetings, there's earnings, there's all these things. And so a lot of clients just want to isolate the event. And you can set up trades around particular events, or you could fade events, whatever they are. And so one thing that we'll try to do to help, attain liquidity and also help our market maker and people is to sort of isolate those events and try to sell a call that expires before an event to buy a call after an event, and be very, very real. Like, hey, there's earnings or there's an analyst day. This is why we're doing it. We think stock's going to rally after, but it helps the market maker then get the trade on and provide the liquidity that we need.
That's interesting. So some people put things up delta neutral. Some people put things up delta neutral against other options, right? Stina, what kinds of things are your clients doing to get more liquidity?
Yeah, I think look, from a liquidity perspective, there's a lot of things that we try to do. I mean, obviously there are really large, block trades, and those are going to be best worked by high touch desks where you're looking to put up a really big block. And then of course there's all those really small trades and institutional trades. Or not. I mean, a lot of institutional trades are 5, 10, 20, 100 contracts, and there's a lot of liquidity for those on the screens. Where we've really tried to improve the experience for our clients is it's sort of in the middle tier there. So it's not a huge block, but it's not something that can easily get done on the screens. And what we've done there is we have an ATS now. So when an order comes in, we take that order, we request a quote on that option from a handful of market makers. And in 10 milliseconds, we get a response from maybe all those market makers, maybe one, maybe none. But in many cases, what we're really able to do there is, while still offering a full electronic experience, get our clients more liquidity than what's on the screen, potentially a better price than what's on the screen, and the third benefit there is possibly saving our clients some exchange fees, and that's a fully electronic experience. So it's been phenomenally successful. It's worked incredibly well. It's something that we really rolled out and sort of pushed starting late in 2019. So it's been a tremendous tool, and really what we're just trying to do is augment that screen liquidity, give an electronic experience, allow our orders to just have market makers respond very quickly, very seamlessly, and find some enhanced liquidity. So it's been really successful.
Well, that's a whole different trading methodology. And has the volume on that been driven a lot by the events of 2020, or is that also sort of organic growth?
I think obviously the more volume we have, the more volume that's going to go through there. Given that those aren't necessarily huge orders, market makers, are really happy to, respond and provide liquidity to those types of orders. I think what we've seen, let's just say sort of outside of, let's say the ATS this year is, on some of the bigger block orders, especially in the single stock names, which, we mentioned earlier, they've exploded. In your opening remarks there, you've mentioned single stock names have exploded. It's been harder to source some of that big block liquidity, I think, for a lot of people out there. There's just not as many firms this year have really wanted to stand up and provide a lot of let's say liquidity in some of the single stock names. Parallax being one of only a couple firms that have really stood out in the single stock names. So it's nice to have some alternatives to tap into a lot of sort of market makers, very, very quickly in a fully electronic fashion.
That's interesting. So at this point, I'd like to remind the audience that if you wish, you can enter questions for the panelists yourselves, and then I'll relay them. But I'd like to sort of keep going on this sort of issues of liquidity, but also sort of start turning things around from 2020 into the future, into 2021. And as you can see from today, a lot of these volatility and volume issues sort of continue to be with us. Right. What do you see going forward, Danny? What do you think about next year? Do you think this keeps going, or do you think we turn back around?
So this is I've been kind of thinking about this a lot lately. Like, what is next year going to look like? And usually, what has worked in the past won't work in the future. There was a client of mine who used to say, once a bank shows him a back test, he knows it's over. So one back test that we've sent around is buying calls, buying at the money calls in the S&P every month. Let's just say I bought at, or in Qs. Even Qs is even better. You just make money every month. In 2017, this should always makes money. I don't think that's going to last. I think next year, the change will be that the market won't go up in a straight line. I think it'll be more challenging. I think there'll still be volatility, but I think people who can tactically overwrite, I think will have a good year and will do well selling options. Risk premiums have expanded. You're actually getting paid for selling calls. This is the opposite of 2017, where you didn't get paid anything. Now you're getting paid for selling these calls. The people who can combine that fundamental view and take advantage of elevated volatility, I think that's what will be I think that's what we're going to see next year. And I do think vol is going to have to stay bid because you can't really use treasuries anymore to hedge. So there'll be some sort of insurance premium attached to options. And that could mean I buy calls, I sell stock as a hedge, I buy puts to hedge. It doesn't matter. So there will be some premium, but I think the vol sellers potentially could have a good year, especially since there's way less than there was to start the year. So that's kind of my takeaway. I think the tactical overwriter, it'll be a great year for you.
That's interesting. Well, I'm going to come back to some of those points. Will, what do you look forward to in 2021?
Yes, agreeing with Danny, I think, for the last, prior to 2020, we saw 8 or 10 years of vol selling work, and it was a self-fulfilling prophecy where people would sell volatility and they'd make money and they would attract more capital, and it had a very vol suppressing effect. And initially, it was driven by 0% interest rates and a search for yield. And it was a self-fulfilling vol dampening process. And now that those traders aren't gone, but they've certainly were significantly hurt in March. Anybody who was short vol and struggled this year. You couple that with the increased demand for volatility, both from the institutional and retail base, and I agree. I think that the supply-demand dynamic has shifted. We've seen it. The fact that the market, as I said, has been near highs and vols remained high. I've never been able to predict the catalysts or we're going to have this great event that's going to cause volatility. I have no idea what's coming. But with the market having rallied as much as it has and as much instability of this there is in this world, I would be very surprised to see 2021 be a low vol year. And by low vol, where the VIX is consistently, say, sub 15 or even sub 20 at this point.
Wow. Dino, what are your views on that?
Yeah, no, I totally agree. I think we're going to see continued volatility. I mean, 2021, with COVID, possibly a new White House, there's just a lot of uncertainty out there. I don't see volatility coming down drastically, anytime soon. I think for 2021 could be a good two-way trade too. I mean, this year it's, obviously we've gone on for a long time. We've had a couple of, extremely down, extremely up. We're chopping a little bit. I think we're going to be, volatility will definitely be there. I think we'll have a good sort of choppy two-way trade next year. And I would expect volumes to continue, pretty close to the levels that they're at right now. I don't see things slowing down certainly in the next, 6 to 9 to 12 months.
One thing
go ahead.
Sorry, one thing I'm also keeping an eye out for, and this was reminding me of 2009, there was an explosion in tail risk funds. That was like after the market already sold off, then we just want to hedge. If we start hearing about tail risk funds becoming really popular and gaining a ton of assets, that would make me think VIX is going below 15. So if we see a headline that someone just raised $10 billion to run a tail risk fund, I'd be very concerned that vol is going to stay high. But that's like the one thing that I'm worried about. But besides that, I agree with the rest of it.
It's funny you say that.
Go ahead.
I was going to say, because we are absolutely right. 2009, I have these investor meetings, and like 50% or 75% of the time, all we talk about was tail risk, and we really haven't been having those conversations this year. I think the event happened, and now we're back up, and people are not hedging the way they were in 2009.
It's so strange though. The vols stay bid, right? I mean, that's the thing. I think many people are thinking this is just a one-off, right? And so, they're not really, internalizing it in that way. And even here, you're saying like the VIX is going to stay bid, but what that really means, or vols are going to stay bid, what that really means is that it's an opportunity to sell them, right? That basically you'll finally get paid for selling vol, right? Which you've not gotten for a long period of time. So you're basically saying, all right, vols might be elevated, but they're fairly priced. Is that correct? As I'm asking you,
me at the end of the year next year.
Yeah, I'd say it depends on when we're looking. Like I think today, yeah, vol is elevated. There's opportunities to sell things. There's also a big event next week, and we'll see. Typically, it's funny like how we're selling off today the week before the event because everyone is hedged specifically for one thing. So my takeaway is that usually when an event passes, volatility will tend to drop, and then perhaps you start looking for what are the next signposts, when are the next one of the next things I should start getting worried again.
One of the points you made was that like treasuries are no longer a good hedge, right? And so like your only place to hedge is the options market, right? And that's a structural change, right? Like that's and the Fed has come out and said, hey, it's going to stay this way for a while, right? I mean, how long do you think that would persist? Is that the kind of thing where if you watch treasuries, start moving, then you would say, well, okay, maybe the vols should come back in? Or do you think that's a solid shift?
I think our firm view is that rates are not going up for a long time, and so I think that it's here to stay. If you need to hedge, obviously you can go to the FX market as well and buy volatility there. But it seems like the listed index and listed ETF and equity market is the way to go, and I think that's not changing for a long time. A lot of people, like risk parity, is that they have to change the way they view hedging in general. And I think being long cash is also going to be, perhaps at a premium. But, there's a chance I'm also talking up what we all do. But I do think, like, if you were hedging with treasuries, in March, that's how books shut down. And the one thing is not correlated to stocks going up is puts. So, I don't see why that would change. And I think if anything, it'll get, there'll be more interest there.
Well, this brings us to a question we've heard from the audience, which is, right, index volumes, right, have not followed the trend of everything else, right? Index volumes have declined quite a lot this year, and they don't seem to be recovering to the status quo ante, right? Do you think that's a permanent change, and why do you think that is?
I don't know. I think if we have a large event, people will flock back to the index, but we just haven't seen, the hedging flows and that we historically would have. It's all been driven by single stocks, and to Danny's point, people just buying calls, and that's been working. I think it's much more a story of a growth of single stocks as opposed to a decline of index. Like we saw an appropriate spike in index volumes in March, and I think an appropriate decline. And the surprise has been how much increase there's been in the single stocks.
And also in the VIX complex in particular, in January of 2018, you had those ETNs blow up, and that also reduced just the use of VIX options in general. And that was a big growth driver in the index side. So I think that is definitely a part of it. And to Will's point, certainly single stock volumes have exploded, less so than index have shrunk, I'd say, and ETF as well.
That's very interesting. What is so, not to get into the outcome of the election, but there's a possibility that the election isn't fully determined at the moment the event is meant to occur. How do you see people shaping up and hedging for that, or do you think they're hedged for that?
Well, we've certainly seen demand, and you see it in the index complex. The vol had shifted out. Initially people were buying no volatility, and specifically November 6th, but then they started buying December and January and pushing their hedges out. So rather than seeing one single event, we see sort of a time period of elevated volatility in the marketplace. So I think that most people would agree that there's a high likelihood that we won't know the results of the election for at least a few days, potentially a few weeks, and maybe a month after the actual election day, depending on how close it is.
Do you think that's market consensus, or is that something that you in particular see?
I think it is a possibility. I don't think anybody would really disagree with that. How likely it is, I don't. My opinion is that it'll be in probably a week or so or less, and it'll probably be less volatile than people are betting on in either outcome. What we're focused on specifically coming into the election are dispersion-related trades, basically selling index volatility that's elevated and looking to own volatility in single stocks, specifically in sectors that rate to have some election sensitivity, regardless of outcome, whether it be healthcare stocks, technology stocks, financial stocks, and trying to capture some of the premium that people are paying for the index hedges in the market. So people are certainly using indexes to hedge the election, despite what we said about single stocks dominating.
Interesting. So another audience question is, when will we hit critical mass in terms of number of exchanges? Do we have enough? And and what is the optimal number for U.S. listed option exchanges?
I think we hit it like 3 ago.
Yeah.
I don't know. I do. Is there one in Miami now? That's the one that I want to go visit.
There is the Miami Exchange.
I think it's physically in New Jersey, but I believe it's named the.
Oh, then I'm out.
I think one
Is
option
there
would be
there's
great.
a lot of changes.
Sorry,
They all try to do different things. I mean, look, there's a lot of exchanges, and so obviously it's one of the things that we as a broker in this world. I mean, that's really one of the primary values that we're adding, is really navigating that landscape. And how do you execute orders efficiently when there's 16 option exchanges now? They've got different there's different fees. They've got different sort of priority in terms of like when you're posting there. Obviously there's rebates on some when you're posting, there's fees when you're taking, there's inverted, there's maker ticket, there's inverted, there's all sorts of things. I mean, we have enough exchanges. You have the same market makers on all the exchanges. That being said, they're going to continue to come. We're not going to go the other way. This isn't a trend that's going to be reversed. I mean, obviously being in the exchange business, it's a lucrative business. Exchanges are worth a lot of money. Exchanges make a lot of money. They're going to keep adding exchanges, and we're going to keep providing algorithms that sort of navigate that for our clients. I mean, it is what it is. I mean, there's nothing stopping that trend though. They're going to be adding more. There's more on. We're at 16, and I think there's at least 2 more that have been announced, maybe 3, but 2 for sure that are coming.
That's interesting. Yeah, the economics of the exchange business. It's a scale economy business. It's a huge market. But I mean, again, the trading protocols and different execution methodologies, as you pointed out earlier, with your own innovations. I mean, there's room to innovate, I guess. There's
absolutely room to innovate. I mean, it's in a lot of different areas. I mean, just capturing liquidity. I mean, I think the hardest thing when you're looking at all these exchanges for somebody is, how do I capture the screens? Which is, if everyone's on the offer, let's say there's 1,000 on the offer, you want to buy 1,000 contracts, and there's 16 exchanges, and everybody's got whatever 80 70 contracts up, or whatever the case may be. How do I hit those exchanges at the exact same time, knowing that it's pretty much the same market makers on every one of those offers, and they don't really want to sell, let's say, 500 or 1,000 of those, but they want to sell you 70, kind of back their quotes when the other exchanges and raise their price a little bit. That's what market makers do. It's what I did when I was a market maker, right? You just sold a little bit, you raise your price. Sold a little bit more, you raise your price. Things really haven't changed today. They're looking for information, and how do I adjust my prices now accordingly now that I have that information? So it does give firms an opportunity to innovate. Capturing the screens. It's something we pride ourselves on at Dash. You got to be good at it. You got to know how to calibrate your orders to arrive at the exchange matching engine at the exact same time. They can't. That doesn't mean they leave your door at the same time. That doesn't mean they arrive at the exchange's front door at the same time. It means they get to that matching engine at the same time. And we have a whole methodology of how we do that, and we monitor that all day long on every trade throughout the day and recalibrate how we do that. So with more exchanges creates more opportunity for some firms. It creates a lot of aggravation for other firms. Obviously, it's not cheap for us and other firms that have to connect to all these venues. And, there's a lot of fees and market data, but hey, it's the business we're in. As we said in the beginning, we're growing. Again, 16 exchanges today. In 2000, we had 5. In 2008, I think there were 6. So, I mean, the growth has been huge. It's not going to stop. So we're just gonna deal with it.
Okay, we've got just a few minutes left. I think the last question I want to sort of ask, 2020 was a year with a lot of surprises. What do you think is going to surprise people in 2021? What is the thing that people are overlooking? It's a trickier question, but Danny, what do you think?
What are people overlooking? That is a good question. Here's the 2 sectors I think. How about that? 2 sectors I think will do very well regardless of the outcome. I think cannabis and I think gambling stocks will do well. My guess is that states are going to be extremely underwater in terms of their budgets. We're already seeing the fight with Pelosi and Trump over this. We're going to have to figure out ways to raise money. Prohibition ended because states needed to raise money. How are we going to get money when people won't complain? Tax weed, tax sports gambling. So my guess is sometime next year you'll be able to gamble on any sport on your phone, at least in New York, probably in California, hopefully, and you'll be able to smoke weed on the street. That would be my guess, and I think those type of companies will do well.
That's interesting. It's a municipal finance syntax play. Interesting.
And so maybe call options on those type of companies. I think we'll do fine, and I'm sure will help provide liquidity.
So, Will, what do you think is going to surprise people in 2020?
I think
what's overlooked?
I think we're going to have to get inflation here eventually. We've certainly seen massive asset inflation in the form of stocks, and eventually we're going to start seeing real changes in price, and it's going to start to affect people. We can't keep printing trillions of dollars and expecting the dollar to go the same way, and I just don't see. It doesn't seem like people are aware of it. And it's talked about a lot, and we've been talking about inflation for a long time, but I could see it actually getting a meaningful uptick in inflation in 2021.
What does that mean for options? Because they're a decaying asset.
I think it's good. I mean, it's going to drive asset prices higher, and I think net is probably pretty good for our business. If we had large amounts of inflation, you would see increased volumes or steady volumes, which would be good.
Zeno, you want to finish this out here? What do you think is going to surprise people in 2021?
Yeah, that's a tough one. I don't know if it'll surprise people, but I do think we'll be dealing with the effects of COVID, well into 2021. I don't see an end here, anytime soon. I think a lot of the things we're dealing with today, we're going to be dealing with well into 2021, and I think we're going to see a lot of economic fallout from it. I don't think we've really seen the economic fallout from what's occurred, with the restrictions and some of the effect this has had on a lot of small businesses, but not just small businesses. And I think in 2021, unfortunately, we're going to really see and feel a lot of the economic impact of the destruction that Corona is doing.
Yeah, no, I think that's true. I think the official sector's done a great job on managing liquidity, but solvency is still a question. And again, I mean, even at the municipal and state level, as Danny mentioned. Okay, well, that's pretty much all the time we have. I'd like to thank my panelists for joining us today. This is a great conversation, and we should do it again.
Yeah.
Well, I can.
Thank you.
Good. Thanks, everybody.
Take care.